you know, right now, the biggest struggle is builders just can't get out homes fast enough, right? They're behind with labor, they're behind with supplies, right? So they're actually getting further behind, and there's just more people coming into this market. So anybody that's telling you, hey, we're headed for a home crash, how?
Are you scared of buying in this market? Do you feel like you're buying at the top of a bubble? Are you sick of losing out on multiple offers to all cash buyers? Well, in today's video, I have an awesome friend of mine, a colleague, a great local lender in Park City, Utah, the Wasatch back in Utah in general. His name is Jason Drobeck, and he is with Neo Home Loans. So I'm going to let Jason take it away today. So
Nicole,
welcome to the channel.
Yeah, it's an honor to be here. Thanks for having me on your channel. So I feel like a special guest on a big media format here. So
you're a special guest.
Thank you. Well, I think what's happening in today's market is really stressful, right? We just continue to watch inventory decline, even at a time when home appreciation is going up, right? So those two aren't meeting in a psychological mind for most people who are trying to purchase a home. And yeah, I looked up some stats recently. 1 in 3 homes in the United States right now is being bought by an all cash buyer. Never been higher in the United States. And also at the same time, 1 in 6 homes right now is being bought by an institutional investor. Vanguard, BlackRock, all the big bad boys. That's where they're throwing all their money right now, right? We've all seen the stock market at historical highs. They're probably reading that as saying, cool, it's about to cool off, probably going to take some sort of correction, right? Where should we put our money from there? They're seeing where the opportunity is, which is in property, right? So we want to make sure that we're taking your clients from an educated data standpoint and then moving them into strategies that are actually going to help them, you know, win when they want to go take a look at that home. So again, I thought I would just share my screen here and cover a couple data points because I think understanding what's happening in the market is really the first key to wanting to get engaged and feel confident that you're, again, you know, some of the things I'm hearing from clients, man, this has got to be the top of the market, right? Things are going to crash from here. Yeah. And if you look at the data, there's nothing that suggests that from what I'm looking at. So can you see my screen, by the way, now, Nicole?
Yep, we can see it.
Perfect. So I'm going to share a couple slides here, and let me just start with this first one. This is measured by Redfin, but this is the number of active listings. And then this is on the bottom, and it doesn't show this on the x-axis, but it's the number, it just would go throughout the year from January to December on this right side. And it's just trying to show you what are the active amount of listings happening across all metropolitan areas across the United States. And what's fascinating to watch here is this blue line is 2017, this light blue. This next little darker blue is 2019, and this gray is 2018. So all 3 of these years, we kind of started out about this million mark in listings starting out the year. Well, going into the pandemic, interestingly enough, already down about 10% going into 2020. So it was already heating up pre-COVID, okay? We were down in listings coming into 2020. Okay, we had a rocky year, right? And you can actually see, look at the big tailing. Usually, you know, the tail doesn't happen. It meets where the start of January is. We finished out December of 2020 way down as compared to where we started out that year. That should have given us a really good clue as to what was coming, right?
Yep.
But then come into 2021, we had about 660,000 homes available nationally. And again, brutal year last year. We know every client that went into a transaction last year, it was a bloodbath, right? You're competing against multiple people, escalation clauses, overcoming appraisal deficiencies, rough year, right? So we all said, sweet, couldn't be any worse than 2021, right? And here we are, start of this year, 440,000 homes for sale. And this was measured, you know, about 6 weeks ago. Okay. So again, down 30% in terms of active, actual available listings. There's 330 million people in the United States. This suggests there's about 1 home for every 1,000 people right now.
Oh my God.
Utter craziness, right? So that's active listings. So again, if you're a buyer, you're probably thinking, okay, well, there's got to be some kind of relief coming from this, right? So where I like to take this is from a supply and demand standpoint. I'm a huge numbers person. That's why I do mortgages, okay? So I love looking at the data. But here's what's fascinating is everybody who's been in the market now and who is psychologically just looking at this like, man, home appreciation, which by the way, have gone up 15 to 20% year over year, right? We're up 30 to 40% since the start of COVID. Well, anybody that's seen that appreciation and was around in the last great recession in 2005, 6, 7, and 8, psychologically, we're thinking back to that time, right? That's the last time we saw home prices make these kind of big jumps, right? So psychologically, we're preparing for that bottom and that crash to come, right? Well, let's go through two big data points that support we're in no way in the same type of environment. So number one, this chart says US housing starts, but this is essentially new construction homes coming to market in the United States, okay? On the y-axis here, we've got, this is measured in hundreds of thousands of homes. So this is 500,000, a million, million and a half, and 2 million homes. And this is measured all the way back to the late 70s, coming back to all today. I've only got data obviously up through 2021. If you kind of drew a line through the average and even going back before the 70s, home builders on average, we're building about 1.5 million homes per year. Now we've got some peaks and valleys throughout the years, which is normal. But what's really interesting, I want to point your eyes to two things. Here's the great run up here in the Great Recession, starting in 2004, 5, 6, and 7. Right? This was the pandemonium of the last 15 years ago, where everybody was buying houses. Right? Everybody could get a house that could fog a mirror. Everybody owned 3 or 4 homes. Right? And a big reason for this was home builders were going crazy building homes. At the peak up here, they built over 2.5 million homes going into the crash. So really building a lot of supply of homes coming into the market. And I like to think back to this as well. Back then, you would drive by these communities of 1,000, maybe 2,000 homes being built at a time. And if you looked at the builders' records back then, they were pre-sold maybe 10 to 20%, right? Maybe only 10 to 20% contracts actually sitting on all those homes that were being built. Today, Nicole, home builders build 30, 40, maybe 50 homes at a time, and they are pre-sold maybe a year in advance before they ever start construction on that home, right? So and the reason for that, builders got burned harder than anyone in the last Great Recession, right? Almost all of them went bankrupt. Almost all of them had to redo their entire business cycle. And so they said, great, well, we're not going to make the same mistake, which is overbuilding homes. What they've actually been doing is completely underbuilding homes. For the last 15 years, we've never gotten back to 1.5 million homes being ready in this country, which for a while was okay, right? We had this big excess of homes. But we've actually created now this huge gap, and it's close to NAR, so National Association of Realtors, says we're probably about 5 million homes short in this country in terms of available supply of what we actually should be in terms of had we been building normally. So that's number one. From a supply standpoint, okay, we're in completely different territory, right? And this time we're overbuilding, underbuilding ever since then. So that's the supply side. Now we want to look at the demand standpoint, right? Because those are the meeting in the middle there. Is where is supply and demand meeting? And this is probably my favorite chart that I get to share with people. But this is the number of US bursts by year and then by generation, okay? And again, I've highlighted a 33-year-old in this chart. The reason for that, National Association of Realtors, again, NAR, states an average first-time home buyer is 33 years old. So if you're looking at today's data, trying to figure out what's coming, you would look back about 33 years, okay, and be able to figure out, what's the births coming, right? So where's the demand coming for these homes? So again, this goes through each generation. You can see the number of births on the upper hand axis here, and this just goes through the years here on the bottom axis. Well, again, as we all know, huge explosion population in the United States during the baby boomers generation. Well, even going into the Gen X generation, we already started to see a decline in the births, okay? And then really interesting, I've highlighted this little arrow right here, but this is 1973. Nicole, do you know what law could have gotten passed in 1973 that would have negatively affected births?
I don't know.
History challenge? That's okay. 1973, Roe v. Wade gets passed, okay? Abortion is legalized in the United States. We're not here to debate the morality of that, but what it did do was create this huge trough of births, okay? Really big decrease in births by almost about 1 million for 1, 2, 3, 4, 5, 6, 7 years straight. Well, here's what's fascinating. We just looked at the previous slides. They're building, right? Mm-hmm. And there's less and less people coming into the market. Home builders should have looked at the demographics. They were building too many homes for the people that were coming, okay? Now, flip back. Here's an average 33-year-old today. I'm 34, by the way, so I'm just 1 year ahead in this graph. Increasing bursts for the next 4 or 5 years straight, and then extremely level even going into the Gen Z generation, okay? So we're underbuilding and continue to be, right? We know right now the biggest struggle is builders just can't get out homes fast enough, right? They're behind with labor, they're behind with supplies, right? So they're actually getting further behind, and there's just more people coming into this market. So anybody that's telling you, hey, we're headed for a home crash, how, right? Like, how is that possibly going to happen? From a supply and demand standpoint, we're still millions and millions and millions of homes short from where we would even be to even catch up today. And that's assuming home builders even started building 1.5 million homes today, right? Which they're not going to be able to. So I love the supply and demand standpoint, because if you start there, it just shows you that home building is on a really sturdy platform. The third piece of that leg that I always like to introduce too, this is from the Mortgage Bankers Association, but it's the Mortgage Credit Availability Index, okay? So let's try to measure how hard or how easy it is to get a loan, okay? And again, and this index right here on the left hand, 400 is kind of lukewarm. So pretty hard or pretty easy, not too hard to get a loan, okay? Well, we all know going into the housing bubble, you either had to be able to fog a mirror or be able to write your name on a loan application to get a loan, but not both, right? Like, it was so crazy easy to get a loan back then. You know, stated income, 0% down. Little investment from the client in terms of purchasing the home, right? We heard, if you've ever watched The Big Short that came out, maybe 6-7 years ago, that kind of talked about this, but, funny stories of like, not trying to be mean, but waitresses owning like 3 or 4 rental properties, right? Which from an income standpoint never made sense, right?
Correct. Yeah.
Ever since then, the big crash takes over. Mortgages have never been harder to get, right? That's what this measurement is telling us. We're basically at a 125, right? Everybody that's getting a mortgage right now has been thoroughly vetted, right? Solid income, great credit, and they almost always have to have some kind of down payment or investment into the property, right? So, and I like to go back to this because everybody likes to think, especially after COVID, that there's going to be this big rush of foreclosures that we're going to hit this market. And I even at the time said, no way in chance that's going to happen. One, home appreciation has been going up for 5-6 years behind that. And 2, now it's ramping up in COVID. Anybody that's going to foreclose is just going to sell their home, right? So again, but from an industry standpoint, from a housing standpoint, we're on a completely sturdy platform. I can't think of a more sturdy asset right now than housing. And that's why, again, all those big guys are jumping in to steal all of our homes, because they're looking at all this same data and saying, sweet, perfect. I can see this is on a very long, very steady climbing platform. My income, my assets are very safe sitting here. So in the last, slide that I'll share with you, the other thing that goes out in the media is that housing is unaffordable today, right? Now that's an interesting price. Prices are up a lot, but actually the affordability of a home is actually still in a very good spot. And the way to measure this is take an average home price in 2006 versus today. Now we're up 41%, right? So if you just stopped right here, you'd say, man, that's bad, right? Well, here's the difference. Rates are still almost half of where they were 15 years ago, okay? And at the same time, household income has also gone up during those same 15 years. So this is measured just by the poverty line, but poverty line has gone from 7 to 10,850, okay? So if you're actually trying to measure what's the ratio of someone's monthly mortgage payment, so their housing payment versus their actual income, it's actually still better than it was 15 years ago, okay? It's still more affordable today to buy than it was back in 2006, 7, and 8. So I think I like to round it out with that, with just saying, even where interest rates are today, that's again why it's still an amazing time to buy a house. Now, still a very hard time to buy a house, but something you should definitely still be jumping into. Yeah. So let me stop sharing my screen there. Is there any questions on those numbers or demographics that I can share or answer for you, Nicole?
I think that's amazing. So builders should basically have been tracking the birth rate.
Mm-hmm, correct.
That's cool.
Yeah, no, I think that demographics, that's something we never, we all point towards mortgages crashing the economy in 2005, 6, and 7, which they played a huge piece in it, right? But the other piece is we just simply were building way too many homes for what we really needed, right? It was a gluttony of homes. And nobody was really pointing to that. And I think it's interesting if you look back historically, you're like, oh man, well that really should have cued us in too, that we had an overvalued home or overvalued home market. That's just simply not the case today. So
yeah. That's cool. That's awesome. I think that sheds a lot of light. It was a fantastic presentation, so thank you.
Yeah, you're welcome.
You want to share a little bit about your all cash offer that you have? I know you guys have a program that can
so the big thing is this market continues to evolve. One of the biggest things we're finding is, and one thing that's interesting to go back to as well is, this releasing of inventory back into the market, right? As we would expect as baby boomers age out of their homes, for them to release these let's call them what they are, kind of mega mansions, right? The 4 and 5 and 6,000 square foot homes. Those should be coming back to the millennial generation for their family building, right? Unfortunately, all of these baby boomers have now refinanced to a 3% or less rate. They're looking at the current housing market and saying, due to rate going up and home prices going up, it doesn't make sense for me to take that step down. So we're also losing that access to the inventory. And that really segues in well into this cash product, because we're really at Neo trying to come up with new strategic ways to help people get into their next house, or, you know, whether that's upgrading or downgrading. And the most common issue we're finding out there is people are what I'm kind of terming landlocked in their equity, right? So you're sitting in maybe a house that you bought for $300,000-400,000 maybe 10 years ago. Today, it's probably well worth maybe north of $1 million. So shoot, you're maybe sitting on $500,000 in equity. But the biggest challenge is, you know, you don't really maybe for a lot of clients haven't built up the necessary savings to go put another down payment on their home, right? Most of their savings, and this is true for most Americans, all their wealth is sitting in the equity in their home. So in order to get it into the next house, what kind of offer do you have to do as a real estate agent right now to move that equity over?
All cash.
Well, right. But in traditional ways, you would do a contingent offer, right? So you would say, all right, great. Hey, Mr. Seller, we're going to shoot you an offer that says, hey, that our offer is contingent on us selling our current home that we have.
Oh, yes. And
3 and 4 years ago, that was a really worthy offer, right? Because if anything, you're really strong, right? You're probably moving this rather large down payment over, right? You're already a homeowner. But in today's market, as you know, if you go to submit a contingent offer, you need 45, 60 days, maybe longer to close, because you've got to go sell your current home. There's not a single seller that I know right now that's willing to take that. Because if you've got 15 or 20 offers on the table, A, you probably already got a cash offer, and B, there's probably many mortgage people behind, or people taking finance behind them that are ready to close in less than 30 days, right? So for so many people, they're landlocked in their equity, right? They can't actually get into the next house and move that wealth over into the new home. So what we've created is our own proprietary cash program. Okay, we call it Home Solutions. But the idea is, look, let's stop having you fight with your contingent offer, or even, you know, another common term in our industry is a bridge loan. The other unfortunate thing about a bridge loan is you still go into the next offer as a mortgaged client, as a financed offer, right? You're still behind the gun between everyone, or especially in our market in Park City, where 1 in 2 offers is a cash offer, okay? So what we've created is this Home Solutions cash program. What they will do is they'll step in, they will buy your new home for you in cash, okay? And especially if you have a house to sell on the back end, they now give you 6 months to, one, market your home correctly, right? Because if you go into a contingent offer, you're probably taking the very first offer you get, which may be at a steep discount, right? So proper time to sell your current home. 2, you don't have to move your family multiple times, right? Because if you're not going to do a contingent offer, you're selling your home, moving into a rental, then moving again as you get into the new house, right? And number 3, and most importantly, you're going into that offer all cash, right? So if you're looking at your dream home and you're saying, man, I really want to find a way to win this place, being all cash is that winning way, right? Because we can close in 10 to 12 days. We can waive appraisal. We can waive financing contingencies, really set you up to be the number 1 offer that a seller is going to consider. Okay. Now, I want to also point out this offer, or this program, is not built just for those who have a home to sell. If you have 20% down ready to go for a home purchase, we can also convert you into a cash buyer with this all cash program as well.
That's amazing. Does it work for people who are buying vacation homes and second homes as well?
Correct. Yep. And what we do, part of the process is we want to get you completely underwritten and pre-approved upfront. You know, one of the biggest deficiencies we find in the mortgage industry is lenders are happy to send you out looking for a home with, frankly, what I'll call a poorly vetted pre-approval. Okay. Yes, they'll collect a W-2 and a pay stub and a bank statement, but your file has never actually been in physical format in front of an underwriter. Okay. And robots are taking over our world, and they will, but at least at this point, you still have to get in front of a physical person to underwrite your mortgage. Okay.
And smart contracts. Those are going to take us over soon.
Right. That's a big deficiency. If it hasn't been in front of a physical person and you're just relying on your automated software, that's where the bumps and bruises hand out with mortgages. So again, to get through this program, we're going to physically completely underwrite your file up front. We want to make sure you're never going to have any issue buying the home back from our cash partner. So, and that's really, again, even though we're making sure that you want to move over about 30% of equity into the new home, that's how our cash solution programs get comfortable with, the security risk behind that. That doesn't mean we have to structure the mortgage in the same way. We can set up your mortgage to close in any format that you'd like, limit bigger or smaller down payment that you'd like after your home has sold.
That's amazing. Does it work for someone like doing a 1031 exchange? So let's say that they have so much equity in their Park City home, but it's an investment property. But in order, they still, like when you sell high, you're buying high. So if they are trying to upgrade, they might still need to get a loan. And would they be able to do that, the all cash offer with that as a 1031 exchange?
It's a great question. My assumption would be yes.
Okay.
I would just maybe want to double check with the 1031 exchange intermediary, which is typically a title company or small company, and just make sure that us stepping in as the cash program first, then to have them buy it back the mortgage doesn't introduce a layer that's going to void their 1031 exchange. But all other things, everything met in that will be just fine to still accommodate that for sure.
That's amazing. I have, I run into, we have to sell our house first all the time, and we want to make this offer, and I try to tell them, well, look, like you really should get past your due diligence before you do this. And until you've actually been through the process and you realize how fine the line is, that the fact that your house still hasn't closed and you have one day before your due diligence is up on this house, I don't think people really grasp how bad it can go if something goes wrong with your house. It is just a domino effect. So I think, this is a really great option if you want to win the house in this market. It's fantastic.
The amount of stress you carry just going through a regular mortgage, just through a regular home purchase and a mortgage transaction behind that is pretty intense. Try to introduce that while also having a whole nother transaction going while selling your home. It's a lot going on. So the purpose of this program is to make the stress go down, right? So that you can take all the time in the world to sell your home on the back end. And again, by the way, with where the market, there is a small fee for processing this cash program, which is about 2.5%. And I get a lot of pushback wow, that's a big fee. And two things. One, we know that a cash offer usually gets about 3% less on an offer, okay, when you're all cash offer. So that'll save you right there. And two, if you're marketing your home on the back end with ample marketing time and getting to select all the offers you want, I can almost guarantee you're going to make up that 2.5%, even just being in market another month or two, right, with where things are going. So I think there's an easy way to show that program as being very beneficial, even from the fee that it carries for sure.
Yep. And so you do need 20% down though for this program.
Correct. 20% is the minimum. That's correct.
The minimum. Okay. That's great to know. And then, so once they start this process, are they kind of locked into an interest rate, even though they're cash? So after they close, how does it work to refinance and?
Correct. So we pre-approve them for their mortgage. So until we actually sell their house and now have the proceeds to basically buy it back from our cash partner, just like any other interest rate lock, that's when we'll look at locking their rate, right? Now there's a finalized closing date. So your rate will continue to float while you buy the home in cash and then wait to sell your current home. Because again, we don't have a finalized closing date for basically that up leg transaction.
Right. For the one. Yep. Okay. That's perfect. That's awesome. Where are interest rates going? Are they going to because everything was kind of what I was told, the interest rates are starting to rise this year, just a little bit, nothing crazy. But, and then Ukraine happened. And now we're hearing kind of they're not going to raise interest rates. So I was kind of wanted to get your take on that.
Yeah, let me share my screen one more time if I can here. So this is the chart of mortgage-backed securities here. So let me quickly address how interest rates are actually derived, because that's another media misnomer, which is that Feds control mortgage rates. When Feds are tinkering with interest rates, okay, they're adjusting rates. They're adjusting short-term interest rates. We're talking about intraday banking lending rates. Okay, so the bank wants to lend, Wells Fargo wants to lend to Chase. Here's the rate that you get to use to lend that money from day to day. Okay, we're talking about mortgage rates, which typically have a 30-year life cycle. Okay, so much longer than a day-to-day banking rate. So while mortgage markets take a cue from what's happening with the Fed, okay, we're gonna at some point we're gonna be in lockstep with them. What the Fed does with short-term interest rates is a lot less. I would say doesn't have nearly as big effect as a few other things. Number one, we're actually watching what's happening with the economy, and the number one piece that's happened to mortgage-backed securities has been inflation. Okay. A mortgage-backed security, again, returns a value to the investor, right? So and by the way, it's the safest security collateral in the entire global world. Okay. Like you mentioned, is everybody's seeing a lot of frustration with the stock market as the Ukrainian conflict happens. They're jumping out of stocks and jumping into U.S. mortgage-backed securities because it's always the safe haven for assets. Okay, it's always going to pay a return on its money.
Yep.
Well, if inflation is going up, that means today's dollar or today's assets are worth less than they are going to be in a year, right? And right now we're seeing inflation regions about 6 to 7%. So again, the investors are saying, great, well, my mortgage-backed security, which today is paying me 1.1%, is now only going to pay me 1.0% in a year, right? So again, they're taking those cues from inflation. The second and probably most biggest reaction to mortgage rates increasing, the Fed did come out and say they were going to end quantitative easing, okay? So this is something we came up with in the Great Recession as well, but then we implemented as soon as COVID happened. Essentially, our government, the Fed, is buying back our own mortgage-backed securities, okay? At a clip, by the way, of close to $40 billion a month since the start of COVID, okay? March 2020, 40 billion. April, 40 billion. We're just buying our own mortgage-backed securities and putting them on our own balance sheet, okay? Obviously, that increases demand, which then increases price, and that's what drives down interest rates. Okay, so frankly, they artificially lowered our interest rates when they did that in COVID. Okay, so what you can see here on this chart, and actually, let me just stretch this back all the way to the start of COVID since we've got that timeline on here. A little farther. So here's where our rates were, which by the way is about where we are today, right before COVID. Okay, this is where mortgage-backed securities were trading, and then COVID happened. Fed steps in and says, sweet, we're going back to quantitative easing. We're going to start buying all our mortgage-backed securities back from ourselves. Boom, 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 increase. We went from, basically about 100 basis points on a mortgage-backed security all the way to about 105. And we rode that line all the way through 2020, all the way through 2021 until about December. And that's when the Fed came out and said, no more, we're letting go of our balance sheet and we're stopping quantitative easing. That's also when you heard about short-term interest rates going up, okay? So let me condense this back down to basically December to today. And again, that's where we were at this line, riding really nicely. And now everybody's making their adjustments, right? Mortgage-backed securities are being sold off because if the federal government, the US government's not gonna hold them all, then why are the investors as well? So that's where we've been seeing this big decrease in mortgage-backed securities. And then here's Ukraine just last week, okay? And again, as everybody jumped out of the stock market, they jumped into the mortgage-backed securities, okay? Safe haven, right? And we're gonna continue to see we're seeing really big swings right now day to day, okay? I'm talking, most days I'm seeing like 10 to 15 basis points of sales up or down. I've been seeing like 50 to 60 basis points a day. Big jump, big jump, big correction, right? So in general, here's where I think this is gonna go. If Ukraine turns into a global conflict, we will absolutely see interest rates benefit from that because the stock market will get greatly reduced from that effect. Okay. If it continues to stay a very regional conflict, I think interest rates are going to stay in the same ranges, which is, again, we've gone from about 3% on a 30-year fix for the entire last 2 years, closer to about 4% today. Okay. We've come up a full percent in the last 3 to 4 months. And I expect things to stay in that same range over the course of this summer and through the fall. Yep. And by the way, for a future projection, in terms of interest rates are going, I don't think clients, by the way, should be paying points to buy down interest rates at all right now. There will be another huge opportunity to refinance mortgages sooner if we have a global conflict, by the way. But I think in the next 1.5 to 2 years, again, we just spent $14 trillion as an economy just in the last 2 years going through COVID. Yeah, we went from 7 trillion to 21 trillion in the last 2 years in national debt. Okay. There's going to be hell to pay for that. When there's a huge stock market correction, let me pull up one more graphic for you because I love this graphic too. Every time the United States has gone through a recession, it's been followed by lower interest rates. So again, I think that's going to happen over the next 1.5 to 2 years. Again, this is another chart. This comes out from Freddie Mac. This measures just where interest rates have been. Oh, again, this is interest rate percentage. Right. This is course of time on the bottom here. The shaded parts are recessions. Okay. And again, what you'll see here, increase in interest rates through a recession. After it's done, interest rates come down. Here's a recession, interest rates come down. Here's a recession, interest rates come down. Every single time over the last 50 years. Here's one coming up here. We're going to see another chance for lower interest rates. I think we'll get back to those 3%, Frankly, maybe even lower than that after it's all said and done. So again, just from a strategy standpoint, if I were a client right now, don't pay to buy down your interest rate. Take the par rate from the lender, or if anything, get a credit back on your closing costs and take a little bit higher rate, right? So you're not paying for that rate, and we'll be able to refinance you in about 1.5 to 2 years would be my guess.
That's awesome. How about the like what's happening with the second home interest rate? Because I know they changed the law, correct? Like starting April 1st, I believe.
Yeah, so not necessarily a law, but not so again, let's go back and let's drive back to this. So our government-sponsored entities, these are Fannie Mae and Freddie Mac. So Fannie Mae and Freddie Mac, by the way, were privately owned until the mortgage collapsed in 2005, 6, and 7. Okay. And the government stepped in and said, you did a terrible shit job of managing these mortgages. So now guess what? We're taking over and making sure you don't do this again. Okay. So they're private companies, but they're really government owned. That's why we call them government sponsored entities. Right. Well, the big thing that came in is Freddie and Fannie said they really only want to be keeping about 7% of their book in second home and investment properties. They want it to be 93% single family residences. Okay. They did their last measurement. They're closer to 12 to 13% since the start of COVID. That does not surprise me, by the way, in one bit. What have we been seeing in Park City, right? Everybody flooded in here to come get their vacation home, right? Because everybody said, sweet, I can work remotely. I'm just going to go live where I want a vacation, right? So we've seen this huge influx of people buying. And then again, all these investors buying rental properties because they see where the money in the market's going. So we've seen this huge step up in terms of what's being sold in terms of conventional loans back to Fannie and Freddie. So they came back out, and what Fannie and Freddie do with interest rates is they add loan level pricing adjustments, call those LLPAs. But essentially, if you to get an interest rate, you'll see all these little adders to it. So let's say your credit's at 740. Well, then you got this adder for being above the interest, being above the preferred interest rate. If you're buying a condo versus a single family, there's different adders for that. What they went in and they did two big adders. One, they added a full 1% on conventional loan rates for second homes. By the way, they also added a 0.25% for condos. So we got hit doubly in our market because we're pretty much condo, driven out here. So yeah, if you're looking at conventional loan rates, this just went into effect literally today. So, but we have started implementing this for the last few weeks. But yeah, you'll see your conventional loan rates now on a second home well up near 5% at this point. And this is where our market, because a lot of times we have higher conventional loan limits than standard. So standard across the country is 647. In Wasatch and in Summit County, you can go all the way up to 980. So when you're in between those levels, you get to pick, should I go conventional or should I go jumbo? Okay. And right now, jumbo is going to look way better in terms of interest rate after those loan level pricing adjustments. By the way, though, jumbo is much harder to qualify for. Okay. That's why they have better rates now, right? So this is where due diligence up front with your lender and getting a really good pre-approval is so important. Qualifying for a conventional loan versus a jumbo, completely different reviews. So
awesome.
Yeah,
well, that was great. Wow.
Yeah, thanks for having me.
I learned so much from you. You're fantastic with the numbers, the way you explain everything. It's just kind of like not my lane. So I need to bring on somebody who it is their lane, that can break it down. Where can people find you? How can they contact you?
Appreciate that. Yeah, so we're with Neo Home Loans. Again, we're a local Utah mortgage independent company here. You can find me by going to jason.drobeck@neohomeloans.com. My cell phone number is 720-436-3356.
No, you have a YouTube channel, don't you?
I do. Yep. Yeah. So I'm gonna take this and we'll cross share on there as well. I just take questions that I get from clients and try to post media on that, just because I think it's an interesting way to get answers to your questions. So.